Hi, everyone. I'm Rob Leibel, head of the Americas for BMLL, and I'm joined today with Dr. Elliot Banks, our head of product. Um, this is part of our ongoing series of webinars that will be recorded. You will have the ability to ask questions by utilizing the Q&A button at the bottom of your screen, and we will make this available at a later time. In terms of the housekeeping, I think that's pretty much it. Elliot, is there anything that you wanted to say before we start to get into it?
No, just hello and welcome everyone. Great to do another one of these webinars. Looking forward to the discussion that we're going to have.
Great. So Elliot, retail trading has recently come back into the spotlight after that initial kind of surge known as the meme craze a couple years ago. And focusing on the US for a moment, consensus is, retail trading's in the 15 to 20% range. Some stocks are obviously way higher. Retail trading apps like Robinhood, fractional shares, odd lots, free commissions via payment for order flow, and more recently, zero-dated options have all contributed to the desire and the ease in which the retail community can trade. The angst of the institutional community has always been that it's difficult to interact with this order flow because most of it is done directly with the wholesale market-making community off exchange. One of the SEC proposals was to force this retail flow into competitive auctions, which Gensler envisions helping to democratize this order flow. But based on the September 18th announcement by the SEC, that segment of the plan seems to be on hold or delayed or even dead on arrival. I won't even get into the controversy of having AI gamified trading apps, which seem to be very similar to the online betting, which has exploded in the US recently. So a lot going on in the retail space. And given this backdrop, how do we even start to unpack what investors and traders can begin to glean from the global granular data with respect to retail trading?
Great question, Robin. I think there's a lot of pieces to unpack there. I think before we dive into too much of the sort of the technicals, I think it's worth just reminding, especially in the US, how where things trade in the US. So here I've brought up BML Advantage, and I've actually got, for the first 3 quarters of the year, the breakdown of trading liquidity across the entire Reg NMS market, so the entire US market. And this is the FINRA weekly data that you can take, which gives a lot more color than you get from any of the individual feeds, especially with regards to OTC. Now, what you can kind of see, and we split it into 4 buckets here. There's kind of a fairly standard rule. It's sort of about 60% of this volume is traded on exchange. There's a big chunk which is on the auction, and we've spoken a lot about the auction before, with the rest being continuous trading during the day, and the rest is OTC. And there's sort of 2 ways that that's traded. One is the sort of the wholesale market portion of that. That is very much retail. That's a huge dominated area of retail. If you dive into that, you can see some of the, the familiar names, your Citadels, your Virtues, Jane Streets in there, who are providing that liquidity, and that's where that's being traded through. If we step back out, the other part of that sort of OTC reporting and trading coming through is the ATSs, which we label as dark. Again, diving into this, you can see some of the venues that you typically expect to see there. This tends to be institutional flow. So really, a lot of the retail, and most people, when they think about retail in the US, they're thinking a lot about this sort of wholesale broker component of it, which you can see here. Now, a key part of this is delayed data. So the FINRA give you this data on a 2-week delay at a week's aggregation. So you can't sort of dive down and understand where in the day is it trading, how different stocks are behaving sort of on a per day per hour basis, and when and what interactions that's happening with the rest of the market. The SIP will typically just tell you that this is FINRA and won't even break it down in between wholesale and ATS. But actually, one thing which is spoken about a lot less is the on-exchange retail mechanisms. Now, these are smaller. The majority tends to trade on this sort of OTC wholesale broker segment, but nonetheless, it's quite an important segment. And there's a couple of venues where you get some quite interesting flags in the data that give you a little bit more color as to what's going on. A classic example here is CBOE EDGX. So EDGX, yes, it's one of the venues here in the US. You can see explicit retail flags in that because there's a specific retail mechanism where flagged retail orders get priority. Similarly, other exchanges in the US have different retail components, retail mechanisms. Some are sort of retail and price improvement. There are other views as well. And you can kind of start to build out a bit of a picture of this on-exchange retail components. If I go to here for a second, here from the data lab, we've actually taken a bit of a look and pulled that together. And you can see estimated proportions of retail across these different venues. One thing to point out, what we haven't included here is Miami. MIAX Pearl Equities actually recently launched a retail flag in its data as well. So while you're not getting a whole view of the market and a lot of it is OTC, there are kind of these hints that you can see in the order book data just to understand a little bit more what's going on, especially when high retail days where potentially more of that, if it can't be executed by the broker, by the wholesale will come on exchange, and often on these favorable mechanisms where they either get some form of priority or other incentives to trade on that. Now, it's interesting to talk about GameStop because obviously GameStop this year had kind of a bit of a re-explosion, if you like, and there was a period earlier in the year where there was a big spike in retail, and we've actually got down here the retail volumes and proportions of retail that were traded on CBOE EDGX, and this is coming from an explicit flag in the data. So it isn't sort of an inference. This is by taking and looking at the specific orders that are being flagged as retail. And you can see here the green line showing you this clear spike in retail volume that's traded. That would reflect across the whole market as well. But what's really interesting is you can see this clear spike in consistent volume of retail that's going on that's, up to 35-40% of the volume on EDGX being retail. So you can start to build out a bit of a better picture of what's going on from a retail perspective. Now, what's important here, this is trade by trade. You can see this in real time. You can see this going on. This isn't something you have to wait 2 weeks for and then get an aggregated basis. So clearly there's a lot of insight which you can start to dive in when you start to look at these fields.
It's super interesting because there is no precise definition, as far as I know, in the US market. And I think what we're suggesting here is that you can kind of look at the trajectory or the rate of change on a day-to-day basis, and that can kind of give you a sense, going forward, what stocks are being affected and are they accelerating or decelerating. And that's very different than obviously EMEA that's printing in real time. So how should we look at the retail space in EMEA?
You're absolutely right. Retail in EMEA and Europe is very, very different. And actually, if I go back to Vantage here, with our retail trades view, which we've now got and then is now available as well as a data set, we can start to build out and understand some of these different mechanisms that are going on. Importantly here, much like a lot of retail, in Europe, retail isn't something that is consistent. There's different markets have different views of that retail. You've got different mechanisms from the likes of Equiduct and others, if you see here, through to more payment for order flow that you'd see somewhere like Germany, as well as the RSP network that you see in the UK. And importantly, what we are seeing is an increased use of retail flags within the market. So here we've pulled out the index as a whole. I can start to drill in and see how are different flags being used. So Zitra actually on 22nd of May, I think it was, launched a retail flag in Europe. So on the German venue. So you can start to see that's picking up, and there's now an explicit flag on trades that are being flagged as retail. Similarly, we've got views. You can start to see how the RSP network, which is on the LSE, has been built out. This is a bit more of an inference. Some venues will give you precise information about retail. Some you've got to build out a bit of inference and understand it. But all of that gives you a view as to these different disparate mechanisms that are going on. The other important point to mention here is retail in Europe is being continuously looked at, because actually one of the things that is being changed by ESMA is banning of payment for order flow. So in Germany, typically retail goes on a lot of almost wholesale broker type mechanisms, the likes of TradeGate. Actually, payment for order flow is being banned by mid 2026. So it'll be interesting to see this develops, and especially with these retail flags and an increased focus on retail across the continent. I believe CBOE's got more retail flags and mechanisms coming out later this year. It will be really important to sort of watch this evolution, and it's a topic that firms continue to spend time speaking about.
Right. Yeah, I know that sometimes if there's not even flags, that we've done some heuristics to try to uncover some of that retail order flow. So if this is something of interest, I would encourage you to reach out to your BML salesperson, and we can do kind of a deeper dive, offline.
We've actually got a question on which I think before we move on, Rob, I think it's worth talking about, which I've just seen, which is the retail flags in EU, US. Are they real time? Are they after the fact? So I think it's worth just explaining this. The flags that we're showing. So we're all obviously T+1 as a provider, but all the flags that we're doing in, say, the US, those flags are in the real time depth feed. So you wouldn't see them in, say, in the US if you just took the SIP. It's not in that data set. But if you were to take the proprietary feeds, so something like the itch feed on CBOE or Pillar or others, you'd be able to use either the flags or do an inference based on things that are coming in real time. So this isn't something that gets put in after the fact. For some markets, you do have to make an inference. You don't get it told, for example, in the UK, explicitly whether things trade on the RSP network or not. But what you can do is you can approximate based on size, based on the type of trade that comes through in the particular flags to give you a picture. But importantly, that is something that is coming in the real-time data. It's not something that's sort of being applied on a T+1, T+2 basis.
Awesome. So just kind of piggybacking on the kind of the dilemma for the institutional PMs and traders, and then the sell side trying to configure their algos, looking to interact with this retail. There are a number of other categories or classifications of trade types that are not directly available to interact with, but they do get counted as part of the overall volume. So can you give us some insights into what is truly addressable liquidity in certain markets, and tell us why that's important to understand?
So addressability is something I think certainly in Europe there's been a lot of focus on, and there's a couple of pictures I'll share in a second which will sort of explain why. But I think in every region it's really important to understand what you mean by addressable liquidity, whether that's looking at trades or whether that's actually looking at information depending on how you're taking that data. So we'll start off in Europe and talk a little bit about what we mean by addressable and non-addressable liquidity. So in Europe, the OTC trading information that you get has a lot of explicit fields around it. It tells you whether or not trades are getting are part of the price formation process. It tells you, the currency it's in, etc. It may be different to the currency of what's actually been traded. So you've got quite a lot of information to build out a view of what is addressable and what is non-addressable. And this is something that by taking the sort of granular data, we spend quite a lot of time looking at. And actually, there was a big regulatory shift earlier this year, which brought into light that in a lot of detail. So here I've pulled up. Again, I pulled this out on Europe as a whole. You could do this on London as well, and you get the same picture. But you see what looks like a kind of big drop-off in terms of volumes. It looks like, from the end of April onwards, you get a drop-off in these volumes, which then shows a smaller amount going forward. And it looks like, actually, there's been some change. There's been some big change in terms of volumes. However, when you take away that non-addressable component, suddenly the story looks completely different. You would not be able to see any noticeable shift from before and after this date. Just to remind everyone going back here, there's a pretty big drop-off. And it looks even more extreme if you look at the addressable, non-addressable only volume, and you can see it's really fallen off a cliff. Now, what happened here was on the 29th of April, the FCA changed some reporting requirements around certain technical trades, give-ups, all sort of really non-addressable trades that were always being flagged as non-addressable, and they relaxed the rules and basically said, you don't need to report these anymore. So what that means is suddenly none of this volume is getting reported anymore. But this volume was never addressable to start with. So it wasn't something as a participant you could actually use and build out. So if you weren't filtering out this addressable liquidity, you might suddenly think that there's been a big change in volumes, when in fact the addressable component of that really hasn't changed. And you can see here again, if I look at a sort of a breakdown in percentage terms underneath, the yellow one there is what we call our special price, which is essentially our non-addressable component of liquidity, and that shows a real drop-off again at that same point in time. Now that's kind of an OTC trading kind of view of addressability, but I think, coming back earlier on the SIP, there's another type of non-addressable liquidity, which is the difference between the SIP and the depth feeds. So this is something which happens we talk about it here quite a lot from some of our customers, is around understanding the difference between the SIP and the MBBO and what you see in the proprietary feeds. So going back earlier, one of the differences is you get these retail flags, but actually it's important to understand that the SIP shows round lots, protected quotes, as they're known. Typically, there's a few shares that are different, but it's around 100 shares is typically the round lot volume, and that tends to be what you see in the MBBO. So that will only take the 100 shares. It means if you've got 99 shares at a particular price level, that doesn't get counted. Now, what you see if you look at that is you can actually start to build out a bit of a picture of, well, what's the difference between the spread that you'd see using the SIP and the spread that you'd see including all the odd lots. Now, these are completely addressable trades. You can go and interact with them. They are there in the market. They just don't get reported to the national best bid offer. And here you can see a picture, and we've done this for the top 500 equities. We've done what we call our CBBO. So essentially, we've taken all of the individual proprietary feeds, which have odd lots. We've combined them together to get a best possible price, and asked the question: what does the spread look like in basis points compared? What does the spread look like for the MBBO? And you can see there's a big difference there. And it's a different kind of addressability, but I think it's an important part of the conversation about addressability is, well, what liquidity is there that is addressable that I may not be seeing? It's kind of the other part of the coin of what volumes can I see that I never could have interacted with.
Yeah, I think that's super interesting. I've never quite understood. Well, I've understood why payment for order flow wants to use the NBBO widespread to give the price improvement as opposed to the odd lots, which there would not be as much price improvement, but the liquidity is available. And so I think this is really interesting, particularly as people try to figure out how much is trading in between the NBBO and they're trying to calibrate their algos, etc. Okay. Well,
Yeah, and actually on that point, Rob, I'd just point out one, when we're going back to that retail question earlier, one of the differences as well between Europe and the US is the very different styles of best execution that comes in. So in the US, it's very much driven from the SIP, the NBBO. That is kind of your benchmark. In Europe, the onus is very much on firms themselves to have their own best execution policy and then prove it out themselves rather than necessarily having a benchmark that they use.
No, great point. Moving along, tick sizes. Also, in the September 18th announcement from the SEC, they changed the minimum tick size from a penny to a half a penny for those stocks that are priced at $1 and above. And I think there's widespread consensus that some stocks like Apple and Tesla, Spiders and Qs are tick constrained, i.e. they would trade at a tighter bidder offer. Coming out of MiFID II, the UK chose to use bands that are based on the stock price, the number of trades. What can we learn from the instances where tick size changes have already occurred, and what lessons can we take away?
So yeah, when we're planning this webinar at first, Rob, these announcements hadn't come out, and then they sort of scrambled out. So we had a bit of fun, sort of doing a bit of analysis to work out what was going on. I think it's worth reminding everyone what is changing. So in the US at the moment today, every stock has a 1 cent tick size. Ignore the sub-dollar stocks because they're a bit different, but everything that trades over $1 has their tick size is 1 cent. This is quite common. A lot of places around the world have that. What some other places you tend to have is a more dynamic tick size regime. Japan's a good example. Same with Korea. Europe's then probably the most sort of extreme in that they have tick size bands, but they also have different dynamic pools of liquidity that will shift around. So there's quite a complex view of tick sizes there that's going on. So now in the US, there's a slightly different approach that they're taking. So they are going to do a calculation, basically get the average spread over a two-month window. The stocks which have a spread of less than $15 a share, 0.015 cents as tick, will be a half cent share. Everything else will remain as a 1 cent share. Now, we did a little bit of analysis on this to try and understand what does that mean in practice. So I think it's worth talking a little bit about tick sizes today and what that means. So here I've plotted for equities, so this is just equities rather than ETFs, the spread in basis points again, so rather than cents versus the price, so the sort of the average price of the stock. And the reason we've done it in basis points is because that gives you a bit of a better picture of what the cost would be if you were to cross the spread, rather than in relative terms to the size of the price of the stock. And what you can see here is, this very sharp line. That's basically at that price. That is a 1 cent spread, which it sort of averages out as. And then you see, as stocks get a little bit higher, as prices get a bit higher, you tend to have a bit more dispersion. And actually, interestingly, as the prices go higher, the spread actually in basis points terms, which is kind of an apples for apples comparison, actually gets wider. So rather than you thinking, oh, well, it's a really high price stock, so a 1 cent spread should be really small in basis points terms and sort of percentage terms, actually it goes higher because the orders tend to sit further away relative to where they would on a lower basis. So you can see here this sort of sweet spot in this curve is actually around $200 to $300 a share. And that kind of explains in the US why you often have firms who do quite a lot of corporate actions to shift their dollar amount to the share price to be in that sweet spot for that liquidity, because actually you tend to see there's a bit of a tighter spread on that. Now, what that also means is a lot of the stocks which are going to be impacted by these changes are actually the lower dollar priced stocks, which kind of makes sense if you think about it. If something's $10 or $15, then a 1 cent spread is a lot more than if it's $100 or $200. So you're much more likely to have something where the spread is around one tick. And actually you can see it here. So we basically ran the analysis that is similar to what would be run by the exchanges when these regulations come in. And you can see for the ones that remain having a 1 cent tick size, the distribution tends to be pretty wide, and we see, this long tail of different stocks of different prices. We filtered down to things we're up to $500 a share. Obviously, there's your Berkshire Hathaway's where it's like $500,000, but it just gives you an idea of that profile. The stocks that are going to change, we then see a lot of them are concentrated in this sort of $20 to $40 range. So there's a lot more concentration around that sort of lower end price. So they're the ones which are more likely going to be impacted. And actually, the other thing you find is you do get things moving in and out. And actually, I think when we did this, we looked in January, there were about 1,500 symbols that were going to be impacted by these changes in January. And then in the November, in the sort of the later on in the year, if you rerun the analysis, you find there's about 1,300. So there's a difference in the numbers of stocks that are actually going to be in these bands. So you're likely to see a change in the number of in stocks when they on a certain day will shift and have a different tick size. Now that shift is something we already can see in Europe. So if we go to Vantage very quickly, we've taken a number of German stocks that actually changed their tick size this year in March. So they changed the liquidity bands that they were in. And you see a lot of effects. You see suddenly the liquidity around at the top of the book jumping and spiking. You see the spreads in ticks terms falling down because these were stocks where the tick size got wider. And you see actually it looks like the spread in basis points has got wider. And importantly, from a venue selection point of view, no one venue seems to be setting the best price exclusively very often. You get down to like 1%, whereas earlier you had points in time where Zitra or CBOE were setting exclusively that best price 10 or 15% of the time. The point here is that with these changes, it's going to be really important to think about what this means from a execution point of view, from a routing point of view, where there's likely to be more liquidity and how that fits into your saw. So all of this building out a picture, and it'll be really important as these regulations come in to be tracking this type of information. And importantly, I think here, Europe is a really good lesson for what some of these impacts and some of these changes might have.
Yeah, I think there's opportunity here to educate some of the corporates that, certainly in the U.S., everybody wanted to have the highest stock price, thanks to Warren Buffett, right? Everybody never split their stocks. But I think the message here is that there is a sweet spot. And it's tighter spreads, more liquidity, cheaper stock buybacks, for example. I think those would be a really interesting conversation to have with some of the corporates. We do have a couple questions coming in. One here, Elliot, is on the large spike in volatility in late March that was largely attributed to the unwind of the carry trade. And a lot of people pointed to Japan as being at the center of this. Can you give us a sense of what markets were affected and by how much, and was there a ripple effect that played out globally?
Yeah, so I think it's let me take a look and see if there's anything actually we can pull up in Vantage on that. And actually, I think here's a plot that we saw that we can pull out just to show the effect of that. So here is the Topics ETF, and you can see this big drop off in terms of liquidity that happened, and in terms of the price as well, around the point of this carry trade, that's sort of falling off. And we don't have time to go through all the details of it, but you can certainly see, and we wrote an article on this, things like resting times suddenly in Europe, for example, fell off pretty dramatically. So there's a big drop in the average time of orders resting on the book. So you can see a real sort of liquidity shift at that point in time. That's really important for execution, because actually what that means is, you know, there's more participants who are just wanting to cross the spread, just wanting to aggress in order to get their trades filled. And you can see that even though there's been, you know, other events early in the year, sort of, or things like witching dates at June 14th, rebalance dates, that is a much more enhanced drop off than you can see anywhere else during the year.
Great. We have run over. I know there were a couple questions that went unanswered. We'll try to get back to you offline on those. So on behalf of BML, thank you, everybody. We appreciate your participation. Elliot, any final words?
No, thank you very much. We'll follow up, and all of the notebooks and the views that we've shared will be available as well. So if anyone wants to take a look at them, we'll share them, make them available alongside the recording of the webinar itself.
Awesome. Great. Thanks, everybody. Have a great day.